In the final section on valuation basics, part four, we're going to look at the Costco share price. One of the things that I remember early on in grad school was a comment made by one of the professors. Good companies don't necessarily make good investments, and the same can be said about bad companies. Bad companies don't necessarily make bad investments. It's all a function of price. And today we're going to look at Costco. And um, as a disclaimer, I love Costco. If I had a Costco and a Starbucks within a mile of my abode, I will be a very happy camper. So we're going in this with I am biased in favor of Costco, but that doesn't mean that Costco is a good investment. So what we're going to do is we're going to apply the mathematics we've learned valuing bonds and debt to valuing common equity, and we're going to see where we stand with Costco, if it's overvalued, undervalued, or fairly valued, and the extent to each of those measures. In this slide, we present Costco financial statements as of December 31st, 2025. On the left-hand side, we see the balance sheet, and the balance sheet is a ledger of assets, and on the other side is financing. Basically, you have assets, and then the financing tells you how those assets were financed. They could either be financed with common stock, common equity. They can be financed with interest-bearing debt, or they could be financed with non-interest bearing debt. And that will also have the share count as of 12/31/2025 and the share price. On the right-hand side, we have the income statement of Costco, and this is for the 12 months ended December 31st, 2025. On the revenue side, we have operating income, sales, and then expenses, we have cost of sales. Now, one thing that we do have to do or be cognizant of is what we want to do is whenever we use any of these numbers in order to determine model parameters, we want to make sure that we exclude non-operating items. So, for example, let's say they sold a division for a gain. That gain on sale, we don't want to include in operating income because that's non-recurring. The same thing with expense. If we have a big write-off or we have a big loss on sale of that same division, we don't want to include that in expense. So what we want to do is have our net income be before these one-time items and non-recurring items. So on the right-hand side, we have the income statement, we have sales, cost of sales, then we have net operating income, and then we have interest expense on the debt, and then we have pre-tax income, and then we have income tax expense, and then we have after-tax income. And we also have miscellaneous rates. That debt interest rate of 5.78%, that's the average for that industry. The S&P 500 average total return is 9.53%. That's over the period, I think, 1900 to 2024. And that's total return. That includes both dividends and capital gains and losses. And then we have the equity beta for the industry. A beta should be about 1 for the S&P 500 as in total. But our equity beta is 1.06, which means that Costco is a little riskier than the S&P 500 as a whole, but it's comparable. And also note that the dollars and shares are in millions, except where we note that. The first thing we're going to look at is revenue margin. And by the definition, revenue margin gives us the percent of each dollar of revenue that goes to the company's bottom line pre-tax profits. So really what that says is out of every dollar of revenue I get, if I'm Costco, how much of that dollar goes to my bottom line? And that's a very important parameter when we talk about return on assets. Now, the equation for pre-tax revenue margin is operating revenue minus operating expense divided by operating revenue. So if we go to our financial statements and we plug the numbers for 225 into that equation, what we have is a revenue margin of operating income is 275,824. And remember that those are dollars and millions. Minus the operating expense, which is 264,852, and then we divide by 275,824, which is operating revenue, and we get 0.0398. What does that mean? If you look at the pre-tax revenue margin graph right below that, you'll see that on the revenue side, for every, so for example, if we have $100, if I buy something for Costco at $100, the question for Costco would it be is how much of that flows through to my bottom line. So in other words, of that $100 in revenue, how much of that is really available to my common stockholders, and that'll have a huge impact on share price. So we can see that revenue is 100%, expenses are 96.02% of revenue, which means that my margin, what I get at the end of the day after I subtract out all my expenses, and remember my expenses are my cost for employees to man my stores, the cost for the employees to man my warehouses, my depreciation on my buildings and stores, all of that stuff adds up. And so what we end up with is on $100 of sales, we only get $3.98 profit. So that's not a lot to work with. So you can see where any kind of hiccups in that is going to have a huge impact on my share price. And this is pretty typical of stores that resell retail product or even food products. The margins are very, very thin. You can contrast that with, say, Intel, which has a lot of R&D. Their margins are going to be huge, but that comes at the cost of doing a lot of research and development, a lot of which goes nowhere. So this is so a margin like this of under 5% is very typical of Costco, Walmart. You're going to see the same thing in grocery stores. The margins are very, very thin. The next thing we're going to look at is the ratio of assets to revenue. Now, the definition, ratio of assets to revenue, gives us the balance sheet investment needed to generate $1 of revenue. So the equation for the ratio of assets to revenue is we take operating assets, divide that by operating revenue. Now, what we want to do is we want to, when we calculate Costco's ratio of assets to revenue, we want to take Costco's operating assets, which is 61,815. Remember, this is in millions. And we want to take the operating revenue of 275,824. And what we do is we divide those two and we get a ratio of assets to revenue of 22 or 0.2241. So what does that mean? Let's take a look at the graph below. We see that revenue is 100 and then the assets are 22.41. What that says is that for me to run my business, I need a certain investment in inventory, buildings, tables and chairs, and all that stuff. So how much do I need? I basically on average I need 22.41% of my revenue. I can pretty much count that as my investment. So as my revenue goes up, I have to make sure that my assets are always at 22.41% of revenue. So that means I have to plow money back into my company. And you'll see that a lot of capital intensive companies, even like for example Intel, my ratio of assets to revenue is huge, which basically means I need a lot of fixed assets and a lot of that kind of stuff in order to generate revenue. But in the case of Costco, because all I'm doing is I'm setting up a storefront and I'm reselling products generated elsewhere, either domestically or overseas, I don't need that many assets in order to run my business. I just need enough assets to build my or keep my stores running, to keep my inventory levels high, keep the warehouse full, and all that kind of stuff. The next thing we're going to calculate is the income tax rate. And the definition is the percent of pre-tax profits that must be remitted to the federal, state, and local governments in the form of income taxes. So whenever we talk about net income, we have to realize that we go through all this effort, like Costco. You have these really low margins, and you're relying on volume. Because your margins are low, in order to make any money, you have to have huge volumes. So you go through all this pain and suffering to generate this margin of, I think it was like close to 4%. And then the government comes in and says, well, geez, that's nice. We want a certain percent of that. And that is a huge expense when it comes to after-tax income, because remember that after-tax income is my pre-tax income, which in this case would be my margin, and I subtract out my income taxes. The higher that rate is that the less and less goes to my bottom line, and less is available to my common stockholders. Now, the federal tax rate maxes out. I think the last time they redid the tax code was around 21%. So you're going to have companies with income tax rates greater than that, and companies with income tax rates less than that. So how do we calculate that? What we do is we take the income tax expense from the income statement, and we divide that by pre-tax net income, also from the income statement. And if you go to the financial statements from Costco, you can see where these numbers come from. So the calculation is income tax expense was 2719. Remember, that's dollars and millions. And then we divide that by pre-tax net income of 10,818. So our tax rate, our federal, state, and local tax rate is approximately 25%. 25.13%. And that makes sense, because if the federal rate is 21 and Costco generates all its income in the US, then once you add in state and local taxes, an income tax of 25.13% makes sense. So now we'll calculate the return on assets, and this will be an after-tax return. And this will have a huge impact on value, which we will see in the next slide. The definition of the return on assets is a ratio of after-tax net income to operating assets. So what we want to do is we want to take equation E1, which is return on assets. That's after-tax operating net income divided by operating assets. And then what we want to do is we want to rewrite equation E1 and give it to some more detail. So if after-tax operating net income would be operating revenue minus operating expense times 1 minus the income tax rate. That's how much, once I have pre-tax income, the question is how much is after tax? What percentage of that is after tax? And we take the operating revenue minus operating expense, that's pre-tax net income. And then we multiply it by 1 minus the tax rate, and that's how much is left over. And then we divide that by operating assets. And in this case, we're going to define operating assets by looking at operating revenue, and then take the ratio, multiply operating revenue times the ratio of assets to revenue, which we calculated on a preceding slide. So we want to, just like we did in many of these slides, is we're starting with a base equation, and then we're simplifying it into something that we can use, and something that we can look at and get some insights out of. So what we want to do now is we want to take our equation E2 and rewrite that and make it simpler. So what we're going to do is we can rewrite equation E2 into E3, and basically say that the return on assets equals revenue margin times 1 over the ratio of assets to revenue times 1 minus the tax rate. And if you go back to the 3 slides, what did we calculate? We calculated the revenue margin on one slide, the ratio of assets to revenue on the other, and then on the previous slide, we calculated the income tax rate. So those return on assets, after-tax return on assets, is a function of those 3 items. And then so what we want to do is we want to use equation A3 or E3 above to calculate Costco's ROA, return on assets. So what we do is we go back to those slides, and we say that ROA equals revenue margin, which we calculated to be 0.0398 times 1 over the ratio of assets to revenue, which was 1 over 0.2241, times 1 minus the income tax rate, which is 1 minus 0.2513, and we get our return on assets, which is approximately 13.29%, which is pretty good. The next thing that we want to do is calculate 2 more rates that we're going to need for our valuation equation. The first rate is extremely important. It's the weighted average cost of capital. When we say weighted average, we finance our balance sheet or our assets with debt and equity, and the mix tells us what our cost of capital is. You usually refer to the weighted average cost of capital as the asset cost of capital. And the table below tells us how do we do that. So we basically have two buckets. We have the financing bucket of debt and then one of common equity. So the debt, the market rate on debt is about 5.78%. And the market rate on equity is 9.53. Now the 5.78 that came from the industry average. The 9.53 we're going to use because the equity beta of Costco is close to 1. We're going to use the S&P 500 cost of capital, which is 9.53%. And what we want to do is we want to weight those, but we don't want to weight them by just by looking at the balance sheet and taking the book value. We actually want to take them look at the market values of the debt and the market value of the common stock, add it together, and we base our weighting on that. So if we look at the industry average, about 8.02% of their assets are funded with debt, and which means that the remaining 91.98% are funded with equity. So now we want to get a cost. So we take in order to get a weighted average, we take the debt rate of 578 times the weight, which is 8.02%, and we get 0.46%. And then we do the same thing for equity. We take the 9.53% cost of equity. We multiply that by the 91.98% weight, and then we get a weighted average cost of 8.77%. And we add those up. So based on their financing bucket weights, we have a cost of capital for Costco, which is around 9.23%. And again, we refer to that as the average or the asset cost of capital. The second thing we need is a revenue growth rate. And we're going to assume that if assets are always a certain percent of revenues, then if revenue grows by X percent, that means my assets grow by X percent. And that percent goes into my valuation equation, so it's important. What we want to do is we want to take the revenue growth rates of Costco. If we go back to 2025, the revenue growth rate was 8.13%, which is good because you have to remember that the nominal growth rate of GDP in the U.S. We would take the real rate, which is the one published all the time, which is around 2%. Well, now things aren't economically very good, so it's going to be closer to 1%. But we take the 2% and then we add in the inflation rate, and that gives us our nominal GDP growth rate. So our growth, given that this is a mature company, our growth rate for Costco should approximate the nominal growth rate of GDP. So in this case, for 2025, it was actually 8.13%. 2024 was 5.05%, and in 2023 was 6.9. So right now we have the and we want to also look at the 10-year Treasury rate is a good proxy for the nominal growth rate going forward at GDP. So we can look at those rates and note that the rate of growth currently, because Costco is still growing greater than the economy as a whole, typically what we would do is we would use a mean reverting model where we start with let's say a revenue growth rate of 8.13%, and then over time we would decrease that to a growth rate of 4.5%, which is a function of mean reversion. You're going to have startups who are going to grow at these huge percentages, but as they mature and as their revenue base gets larger and larger and larger, it's harder and harder to grow it. So one of the things you're going to notice throughout is that the companies that have a very high growth rate, eventually the growth rate goes down to, I think you'd be comfortable to take the 10-year Treasury rate minus 100 or 200 basis points. Because you have to realize that in that 4.5%, if that's a growth rate of GDP, some of that is going to be the growth attributable to mature companies. And then you have a bunch of high flyer new companies that are going to have these huge growth rates. So if the growth rate averages 4.5% for all companies, then mature companies should have a growth rate, a long-term sustainable growth rate of about the treasury rate minus 100 or 200 basis points. And that is, if you read the note to the right, that basically says what I tried to explain. The 10-year treasury rate minus 102 basis points has proved to be a good proxy for the long-term sustainable growth rate. So if we're going to do this model, there's two in the software. There's two options. We can use a mean reverting model, or else we can just use a standalone snapshot model. In the mean reverting model, what we would do is start at a growth rate of 8 and work it down to, let's say, 3.5% over time. But for this quick and dirty, what we want to do is we want to take a look at that and Kentucky windage and all. We're gonna assume that our revenues grow 5% in perpetuity. That's not true overall, but on average, that should pan out. In this slide, we want to talk about building our moat. So what does a moat mean in the context of finance? Now, the definition of a moat is, I mean, we've all seen moats on TV or in the movies. Moat is a deep, wide trench, typically filled with water, that historically surrounded a castle or fortress to defend itself against attacks. That's the key word here, to defend itself against attacks. We can also make the following statement, which is also something I learned in the first semester of grad school that stuck with me forever and is very true. Um, in perfectly competitive markets, long run economic profits are zero. And because free entry and exit of firms continually drive market prices toward the average total cost of capital. What does that mean? Well, let's take a look at Costco. We determined that the Costco return on assets was 13.29%, but its cost of capital is 9.23%. What does this mean in the context of building your moat? What Warren Buffett talked about when he talked about moats is he wants to pick a company that he understands with a product that is such that you can build a moat around its returns. So in other words, whenever you have economic profits, which is you take the return on assets and subtract the cost of capital. So in this case, we have Costco with a return on assets of 13.29%, but its cost of capital is only 9.23%, which means there's a difference of 4.06%. These are economic profits. If economic profits are positive, what that does is it attracts competition. So if I was in the business of a retail store and I wanted to build a copy of Costco, what I would do is I would look at the returns and say, hey, Costco's making 13.29% return on assets when their cost of capital is 9.23%. So therefore, I should enter that industry. And as I enter that industry, both my profits are going to go down, my economic profits are going to go to zero, and Costco's is too. The same thing on the loss side. If Costco had a return on assets, let's say 5%, and its cost of capital was 9% plus, you would see a lot of businesses exiting that industry such that the competition would lessen and Costco's return on assets would over time would go from that 5% level to its cost of capital. So in general, a statement that you can make is in the long term, economic profits are zero, which means that the return on assets of the company will approach its cost of capital over time. And this is very important because when Buffett was talking about a moat, what that means is if I come up with a difference in between my return on assets and my cost of capital, something that's meaningful, what I have to do is I have to say, well, the market is basically going to tell you, you know what, Gary, that's great. I mean, your return on assets is great, but competition is going to come in and they're going to whittle those economic profits down to zero, such that your return on assets of 13% plus is going to go down to 9% plus. And what you have to do as an analyst is you have to say, yes, in general, that is true. But in my case, I build a moat around those my return on assets such that competition will not come in and it will not bring economic profits to zero such that my return on assets decreases. And there's a number of ways to do that. For example, for Coca-Cola, I go to the store all the time and I see Coca-Cola and then I see the generic brands. Well, I'm willing to pay a premium for Coca-Cola because I know that Coca-Cola has a brand. I know what it tastes like, and I basically know what I'm getting. And they have such a long history of supplying good products that I'm going to pay a premium for Coke versus the generic store brand. So basically, what I've done is based on being Coca-Cola is I've created a moat around my returns. So now we're at the point where we want to actually value the shares of Costco. And we want to take a look at the all of our model parameters from the previous slides and just summarize them. The first five items come from the Costco financial statements, and the value of Costco is going to be the value of all of those items, and then we're going to add them up. Obviously, the value of cash and securities is going to be a positive. The value of operating assets is going to be a positive. The value of interest-bearing debt is going to be a negative. And surprisingly, the value of non-interest-bearing liabilities is going to be a positive. So the return on assets is 13.29%. That comes from the return on assets slide. The coupon rate on interest-bearing debt, we're going to assume we're going to use the market or the average for the industry as the coupon rate. The asset cost of capital is 9.23%. That comes from the miscellaneous rate slide. The debt cost of capital, again, we're going to assume that the debt is at market rates, which is 5.78%. And then the last item there is a revenue growth rate. We're going to assume is 5%, and that comes from the miscellaneous rate slide. And note that we're assuming that the ratio of assets to revenue is constant. So therefore, if revenue grows at 5%, assets grow at 5%, and that is the rate that we, at the end of the day, we need. The first item up to value is the value of cash and securities. Cash and securities, what companies do in order to build themselves up a cushion, have cash available for emergencies, cash available for doing M&A deals. They'll build up a balance of cash and marketable securities. Marketable securities are short-term investments that are usually AAA rated or better, U.S. Treasuries. So we look at equation E1. That's our base valuation equation. What we're going to assume is that cash and securities are basically non-operating. And given that the companies are in the S&P 500 have access to capital via lines of credit and all that kind of stuff, the balance of cash and securities really is non-operating. So we're going to value that, and we're going to say that according to equation E1, that the value of non-operating cash and securities equals the GAAP book value. So if we take a look at the table, cash and securities are comprised of cash, which is at 14,161, then marketable securities, which is at 1123, and then we get a total of 15,284. So if we look at equation E2, that's the market value of non-operating asset or non-operating cash and securities, and we're going to assume that has book value. So therefore, the value of cash and securities is going to be 15,284. The next item up to value is operating assets, and remember that operating assets we defined as the assets needed to run our business. So in other words, if Costco has a revenue base of X, then they're going to need an asset base of Y in order to conduct business. And operating assets are going to be comprised of things like the storefronts, their warehouses, inventory, computer systems, phone systems, desks and chairs, everything. So if we look at E1, that's the value of operating assets, and we're going to take that equation from the value of perpetual debt applied to common equity. So therefore, if you look at that equation, it's the numerator is W minus G, the denominator is K minus G, and then we're going to multiply that ratio by assets. So if we take a look at our model parameters, that comes from the model parameters slide. A subscript 0 is the assets at time 0. That's operating assets at time 0 currently. And remember the time 0 for this case is December 31st, 2025. The operating assets are 61,815. Our return on assets is 1329. Our cost of capital is 923, and our revenue growth rate is 5%. Note that return on assets is 1329 and my cost of capital is 923. So I am earning an above market rate on my assets. So therefore my assets will trade at a premium. And that's exactly what we see if we look at equation E2. If we take the values or the parameters from the table and plug them into equation E1, then we get equation E2. So we have the value of operating assets equals the numerator is 1329 minus the growth rate 5%. The denominator is the cost of capital minus 5%. And then we multiply that by our assets at time zero, and we have a value of operating assets of 121, 146. The next up is the value of IB debt. And when we say IB, we mean interest bearing. So this is the interest bearing debt on on Costco's balance sheet. So what's the value? Equation E1, and again, we're going to go from, we're going to take the equation from the value of perpetual debt and apply it here. We're going to say that E1 is the value of interest-bearing debt, which is R minus G is the numerator. K minus G is the denominator, and then we're going to multiply it by the debt principal balance at time zero. So we look at our table, we have B subscript 0 is a debt balance at time zero, which is 81.73. And then R is the coupon rate, which we'll say is 578. And we'll say that it equals the cost of capital because to actually determine what the coupon rate is going to be very, very different given that debt is going to be split up between, short-term debt, long-term debt, a commercial paper, and it's just too difficult to calculate the actual coupon. So what we're going to do is we're going to assume that the coupon rate equals the debt cost of capital, and that's not going to make a huge difference on our valuation. So the coupon rate is 578, and the debt cost of capital is also 578, and our revenue growth rate is 5%. And the market value of that IB debt is going to be equation E2. So what we want to do is we want to take a look at that equation. The value of interest-bearing debt equals, the numerator is 578 minus 5%, and the denominator is the same. And as we discovered when we looked at the value of perpetual debt, if the coupon rate equals the market rate of interest required on that debt, then that debt will trade at book value. In this case, book value is 81.73, so that's the value of interest-bearing debt. So the next item on the menu is the value of NIB debt. And when we say NIB, we mean non-interest bearing debt. So this is perpetual debt without a coupon. So if we look at our base valuation equation, E1, the value of non-interest bearing debt equals G over K minus G times the principal balance. Now, it's interesting to note that in this case, with the case with interest bearing debt, the numerator was R minus G, with R being the coupon. But in this case, the coupon rate is 0. So we just have G in the numerator, K minus G in the denominator, and the principal balance of debt as B subscript 0. So if we go to the first table there, which is our model parameters, B subscript 0 equals the non-interest bearing debt balance at time 0, which is December 31st, 2025. That's 39.7062, and we have a coupon rate of 0, and then we have an asset cost of capital of 923, and we have a revenue growth rate of 5%. So these parameters are exactly the same as the interest-bearing debt portion, but the coupon rate is 0, and we use a cost of capital, the asset cost of capital, rather than the debt cost of capital. And the reason there is that interest-bearing debt will have liquidation priority over most other non-secured liabilities. So if the company goes belly up and they sell the assets, usually what happens is the interest-bearing debt is secured. So they'll be paid off first, and then if there's any money left over, then the non-interest-bearing liabilities will be taken care of. So therefore, the cost of capital is higher. You can make the case that rather than using the asset cost of capital of 923, we may want to use a rate that's somewhere between the asset cost of capital and the debt cost of capital of 578, because the NIB debt is riskier than the as far as being the debt holder, it's riskier than the holding IB debt. Now, non-interest bearing debt is interesting. If we take look at the table to the right, this is the composition of non-interest bearing debt at the end of December 2025. We have accounts payable of 27,665. Accounts payable is if I buy, and this is something that Amazon does, and I'm sure companies like Walmart do, and it's really pretty neat. What they do is remember that Costco sells retail products manufactured by other companies. So what they do, or pretty much, I think it's pretty obvious what they do, is whenever they buy these products to resell, they'll buy it on credit. So the credit may be, and this is non-interest bearing credit. So they may say, in order to buy, like a washing machine from Maytag, they're going to buy the washing machine and tell Maytag, you know what, we're going to pay you for this machine in 30 days, 60 days, 90 days, whatever. But whenever we sell the washing machine, we're going to take that revenue immediately. So that accounts payable is interest-free financing. Imagine if and we have deferred revenue too. In other words, they're taking revenue in advance of delivering. So that's in a sense a liability. And then we have other liabilities, which is everything else, which is 9243. And if you combine that or add up all those items, we have non-interest bearing debt of 39,762. And if we take that 39,762 and divide it by the assets, we can see that of the assets, 52% of those assets is financed with interest-free debt. Now imagine if you bought a house, a $400,000 house that you have a 400,000 mortgage, and the mortgage company says, you know what, you only have to pay us interest on the first 200,000. The other 200,000 is interest-free. Basically, what that means is that your payment is cut in half. So that's a huge value. And the same thing with companies like Amazon, Walmart, Costco. To use interest-bearing liability or non-interest-bearing liabilities to fund my assets is a huge advantage. Because, like I said, we're going to sell an item and collect the revenue today, but we're not going to pay for that item for 30, 60, 90 days at no interest. So that's a huge benefit. So the market value of that is we go to E2. We have the value of non-interest-bearing debt. We take the revenue growth rate of G because remember the coupon is 0. We divide that by the debt cost of capital minus the growth rate. And again, this comes from the perpetual debt computations that we did in previous slides. We multiply that by the balance at 12/31/2025 of 39,762, and we get a value of 47,000. Now that 47,000 is a benefit to us, so that's an addition to value. Remember that perpetual debt, we never get paid back the principal. But in the interest-bearing debt case, we don't get our principal back, but we get a coupon payment that grows and grows and grows, and that compensates for not only not getting our principal back, but also having to cut a check to the bond issuer every year. So the same thing here is that not only don't we have to pay that 39,762 back, but we never have. But that non-interest bearing debt is going to grow and grow and grow, which means accounts payable is going to grow and grow and grow, and we never have to pay that back. So that's a huge benefit. So that 47,000 is addition to our value at the end of the day. So now we're at the point where we want to take all of our value components and add them up and to see where we are as far as the intrinsic value of Costco shares. That's a theoretical value that we're determining here versus what the shares actually sell for to make the call as far as is Costco shares, are they overvalued, fairly valued, or undervalued, and the extent to that over or under valuation. So if you look at the table there, we have the value of cash and securities, which comes from the value of cash and securities slide. That's 15,284. We have the operating assets, which comes from the value of the operating assets slide, which is 121,146. And remember that our return on assets is 13 plus percent, and our asset cost of capital is 9 plus percent. So therefore, those assets will sell at the premium because we're making over and above the cost of capital on those assets. So the value there of the operating assets is 121,146. The value of interest-bearing debt is 881.73, and that's a subtraction because we have to make coupon payments on that debt. The value of non-interest-bearing debt is 47,000, and that's an addition because not only do we have to not pay any interest on that debt grows and grows and grows over time. So if we add all that up, the market value of common equity is 175,257, and that's a value of all the shares. So then we take that number and divide it by the number of shares, 445, and we get a calculated value per common share of 393.84. And then we look at, say, okay, well, the share price per our calculation should be 393 and 84 cents. But what's it actually selling for? The market value of Costco stock as of the last time I looked at it was 956.32. So the percent of overvaluation is about 59%. So we're staring at a case where we calculate that the intrinsic value of these shares is 393, but they're selling for 956, which means that this stock is way overvalued. And we go back to my previous statement, something I learned in grad school, like my first semester. Was good companies don't always make good investments, and bad companies don't always make bad investments. It's just a function of price. So here we have Costco, and I love Costco, as I said. It's a good company. They make a 13% return, and their cost of capital is only 9 plus. So they're doing well. Costco has a brand, and just like Warren Buffett has said, they pretty much build a moat around their returns. So that is a good company, but it's overvalued. And that's what we see here, where we have a share price of 393. The actual price is being sold for is 956. So you're overpaying for that stock if you buy it for 956. So now we're at the point of rationalizing our calculation of the intrinsic value of the shares at 393 when actually the shares are actually selling for 956. Now, to say that the shares are worth 393 when the share price sells at 956 goes against the efficient market hypothesis. Basically, that hypothesis says that share prices at any given point in time reflect all known information, so they're all so shares. All shares are fairly valued. So what we want to do here is look at and basically come up with a rationale of why Costco would be selling at such a share price that's greater than significantly greater than its intrinsic value. So let's look at the 10-year Costco price chart. Now this chart has been adjusted for dividends and stock splits, so it's an accurate chart. So we this is a 10-year chart. So if we go to the beginning, we can see that over time the share price was started at 10 years ago at a little under $200, and then up until 2020 it was maybe $300. Not that big of an increase over 4 or 5 years. So we want to say, and then we take a look at 2020 and say, well, what happened? Look at how the share price is going at a slight increase, which we would expect. As the revenue grows, the share price should increase. I mean, that's the whole idea or behind owning a stock. But right around 2020, what happened? There was this big blip, upward move in stock prices, or at least in the Costco price. And then around 2023, we had an even bigger increase in the stock price. Well, this is the classic sign of a bubble. What happened in 2020? We had COVID. So when we had COVID, the government was printing money and sending it out to normal citizens who no longer could go to work. So what did they do? They day traded. They basically said, well, if I can't make money or my job or I'm getting unemployment benefits, I'm going to play the stock market. So we had all this liquidity, all this printed money chasing a limited number of stock, and so what you had was a bubble. And then we see that you have basically two bubbles here. The first bubble was COVID, and then the second bubble was just recently when you have this mania where nothing matters in the economy or as far as stock prices go because stock prices are completely divorced from the economic realities, which is the situation that we have now. So we're in a bubble. And that's the reason why Costco could sell for 9.56 when we calculate the intrinsic value to about $400 a share. We can also see that by looking at the PE. That's the first table to the right. We have the stock price of 956.32. Now the earnings per share is at the end of 2025 was 18.24. And if we divide those two, we get a price earnings ratio of 52.43. So in other words, that says is for every dollar of earnings of Costco, I'm willing to pay $52.43 for that. So my price earnings ratio is 52.43. And the question is does that make sense? Well, let's look at history, the historical PE. Now the mean, this is over the period 1900 to 2024. The mean is 1642 and the median is 1537. So we have a historical PE of around 16. And then we look at Costco and say, well, geez, their PE is 52 versus what history says should be 16. And that's another indication that this thing is overvalued. So what we also want to do to rationalize our intrinsic value around $400 a share is we basically say, well, Costco is 59% overvalued. So therefore, we can take its PE and multiply it by 1 minus 59%, and we get a PE, adjusted PE of around 20, 20, which is in line with what the historical average has been for the market as a whole. So that concludes our slide on valuing Costco. I hope that was informative, and I hope you can come join our community. What we do is we provide the software with all of the calculations we made in these slides, and there have been a couple of hours of presenting, going through financial statements and pulling out what we need, making the ratio calculations, plugging them in, developing the models, plugging them into the models, and all the rationale of saying what is the intrinsic value of Costco versus what it's actually selling for. All of that is done for you. But the information is all there, but you still have to run the models yourself and make your assumptions yourself. I've been contacted by a number of people who said, well, why don't you just use the software to make calls on stock prices? In other words, make recommendations as far as stock prices. That's not the point of the software. The point of the software is to build a community where we can all learn from one another and really look at stock prices rationally. And one thing I've learned from my Wall Street gigs is that at the end of the day, you are on your own. There is no one looking out for you other than you. If you are the one who's maintaining your finances for your household, you are the one who has to make the decisions, and no one is going to bail you out. And if you make a mistake, that is on you because your stockbrokers don't know anything really. I have a stockbroker friend of mine who I started. Really, what happens is he was working for Merrill Lynch, and every Monday morning, the stockbrokers would all huddle around the a conference call where the analysts, the CFAs at Merrill Lynch, would give their spiel on what they think is going to happen to the market, over the next week. And I started questioning them on it. All my theory has always been, if you really want to know if anyone knows what they're talking about, always ask the follow-up question, because a follow-up question is probably they're unprepared. If they don't know what they're talking about, chances are that they're not going to be able to answer the follow-up question. So I kept asking him questions, follow-up questions on, valuation and this and that, and what he was telling me. And he got frustrated, and he basically, he's a good friend of mine. He says, you know what, Gary, at the end of the day, I'm just a salesman. And that is true. Your stockbroker doesn't know any of this, chances are, and they're just a salesman. And when I worked my Wall Street gigs, I was expecting to come out of grad school and be able, and to, I passed the CFA exam, and I was expecting to, okay, now I get to apply this in the real world. And I found out that Wall Street actually works very, very differently from what they teach you in the textbooks, which was a real shocker to me. And that was pretty much the genesis of this software, that we're going to work together, we're going to learn from each other, and we're going to try not to make any huge mistakes, and try to latch on to pretty much, you buy low, sell high. And that concludes this section on valuation basics. Thanks for being patient with us, and I hope to see you in our community.